Good morning. It's Friday, the 31st of October, the last day of the month. And this is Aditya Birla broadcasting and streaming weekdays from Mumbai, India's financial capital. Our top stories and themes: why the Trump-Xi Jinping meet after 6 years won't really help markets. And the US markets turn weak. Why is that happening? Decoding the Federal Reserve's rate cuts on Wednesday. How more Indians are borrowing money at record levels for consumption and the dangers that come with it.
This is a Core Report with Aditya Birla.
The US-China mix. You can go by the news reports of the first meeting between President Donald Trump and Chinese leader Xi Jinping in 6 years, which I'll come to, or watch the official video from yesterday in which Donald Trump does all the talking, even patting Xi on the back as he often does, and Xi Jinping's expression is, well, expressionless, giving absolutely nothing away. Now, the Chinese like everything pre-scripted, as do, to a fair extent, Indians. Trump, of course, thrives on these unscripted moments and not the most conducive starting point or maybe halfway point for negotiations or discussions. So it was awkward, it appears, and thus, in my estimation, not a very encouraging sign of things to come. What it does mean is that the two sides, that's the US and China, start firing at each other again, mayhem will resume or continue in global trade as it is right now. Now, the latest agreement does include a reduction in stiff US tariffs on Chinese goods in exchange for a pledge by China to crack down on chemicals used to produce fentanyl. China has agreed to pause for 1 year the sweeping export controls on rare earths, which it announced on October 9th, which kicked off the current fracas. The US cut tariffs on China related to fentanyl to 10% from 20% previously. And importantly, this reduces the overall rate on Chinese goods into the United States to around 47%. Trump said in a report in Wall Street Journal that Beijing has promised to buy tremendous amounts of American soya beans. But the agreement does little to address the fundamental divergence between the two superpowers whose economies are decoupling in many sectors and are racing for supremacy in areas like artificial intelligence, according to Wall Street Journal. Trump was, of course, quite effusive about that meeting, and he said that on a scale of 0 to 10, with 10 being the best, he would say that the meeting was at a 12. Meanwhile, according to the Wall Street Journal report, China has already ordered several soya bean cargoes from the United States grain handlers earlier this week, helping, of course, American farmers who've been in a panic this harvest season as trade tensions caused Chinese buyers to source the crop from elsewhere. And the drop in Chinese purchases has also hit Trump's rural political base hard, says the Wall Street Journal. And US soybean farmers had called on the administration for help as they dealt with billions of dollars in lost sales to the world's largest soybean importer, being China. Now, the question, of course, is that if this agreement lowers tensions between the US and China, the straight answer is yes, going by what we saw on Thursday. But we do not know for how long and in what form. Trump is known to change his mind, and President Xi's expression, well, gave away nothing in any case. If there is tension with China, quite likely there will be tension elsewhere too. India, of course, who could have been, but was not really present in and around Trump during his Asia visit, will have to wait a little longer for a potential agreement, which, of course, we're told is very close to being finalized. On the other hand, with a lower tariff than before, China is definitely more competitive than it was last week in sending goods to America. And of course, that makes it more competitive in relation to other countries who are also exporting into America, including for similar goods like India. Now, markets, of course, are stretched right now, and going by the past, regaining a peak is usually when there is selling pressure every time the markets attempt to gain that peak or reach that peak. Remember, the benchmark indices have gained over 5% so far this month, and we are, of course, near lifetime highs that we last saw in September 2024. On Thursday, the Sensex and Nifty were lower following those weak cues after the US Federal Reserve cut interest rates as expected, but said that it may not be the last cut. Or rather, it may be the last cut of 2025, which means no more cuts in December as some were expecting. The Sensex was down 592 points to 84,404. The Nifty 50 was down 176 points to 25,877. In the broader markets, the Nifty mid-cap was up slightly, while the Nifty small-cap 100 was down also very slightly. The rupee, meanwhile, fell to its lowest in 2 weeks on Thursday as outflows worsened the hit from a hawkish tilt in Federal Reserve policy, which sent the dollar and US Treasury yields higher, according to Reuters, which added that the rupee closed at 88 rupees 69 paise against the dollar, down 0.6% for the day after touching a 2-week low of 88 rupees 73 paise earlier in the session. Gold prices are slightly up, but they're of course now below their all-time highs. And spot gold was up 1.3% to $3,980 per ounce on Thursday morning. Wall Street pauses. Wall Street paused after a long stock rally after the Federal Reserve tempered expectations for a December rate cut, and Meta platform stock fell 12% as the social media giant is taking on debt to fund its artificial intelligence push, according to a Bloomberg report. While the US and China have agreed to a 1-year trade truce, as we just talked about a little earlier, many investors are seeing that agreement as mostly priced in. And there are, of course, questions still unanswered. Bond yields continue to rise alongside the dollar as money markets reined in their expectations for policy easing, said that Bloomberg report. Now, the latest development says the report did give some reasons for the stock market surge to take a breather after multiple warnings about high valuations and a significant narrowing of participation in recent days. Analysts told Bloomberg that none of this means that the AI bubble is going to burst and that we are on the cusp of a major reversal in the stock market. However, it does raise the odds that we could see a short-term pullback at some point soon. Federal Reserve rate cut. The Federal Reserve on Wednesday approved its second straight interest rate cut, though Chair Jerome Powell turned markets nervous after he hinted that there may not be another reduction coming in December. The central bank's Federal Open Market Committee, by a 10-2 vote, lowered the benchmark overnight borrowing rate to a range of 3.75 to 4%. In addition to the rate move, the Federal Reserve announced it would be ending the reduction of its asset purchases, a process known as quantitative tightening, on December 1st. Now, the markets, as we've pointed out, seemed unhappy that the Federal Reserve was playing down a December rate cut. So what can we take away from that? And of course, how are prospects for India's own debt and fixed income markets? I spoke with Abhishek Bisin, head fixed income at Kotak Mutual Fund. I began by asking him to explain the Federal Reserve rate cut to a layperson.
So rate cut is a monetary measure, easing or tightening, depending on if you're cutting, it's easing, and if you're hiking, it's tightening. It is like dropping a stone in a still water. The larger the stone, the higher the ripples will be created and the farther it will go. So a 25 basis point is a relatively a smaller measure, therefore the ripples will be smaller. So accordingly, there is an impact on the across what we call the yield curve. So the shorter yield curve will be impacted the most because it has a very direct correlation. And as it goes farther, as the ripples fade, so that also fade across the curve, and the longest end may or may not have an impact, because markets have a tendency to discount these events in advance. And sometimes market may believe that this is a very short-term measure. It may not last for a long time. Therefore, it may not impact the longer end of the curve. So when the Federal Reserve cut interest rate by 25 basis points, as I said, it was largely expected. So since it was expected, it was largely in the prices. Therefore, the prices moved slightly adverse because they did not give any indication of something more than expectation coming in quickly. Therefore, markets, rather than moving this side, at least on the longer end of the curve, moved the other way around, while the shorter end of the curve was relatively benign and it was very well behaved. And effectively, the curve became steeper.
India is now at about 5.5% repo rate, and we've not had any cuts since June 2025. So if there is easing happening in the rest of the world, or at least in the United States in this case, does this have any kind of indirect or follow-on effect on what we are seeing in India or what we are experiencing in India?
Yes, definitely. At the end of the day, markets hate uncertainty. The riskier the instrument, the more will be reflected in the price of the instrument, in terms of the price volatility will increase if there is a lot of uncertainty. Half of the people will go this way, half will go that way, and eventually you will get volatility all across the markets. And the fixed income market, the shorter end, which is have a direct correlation with these events of rate cut and rate hike, will remain relatively calmer. So if you just look and decide your order of the day by looking at the overnight rates or 3-month treasury bill or a 6-month treasury bill, you will feel everything is in order. But as you keep going towards the longer end of the curve or the equities or the commodities, you will find chaos everywhere. Markets want forward guidance. They would like to discount the farthest end of the future to the best possible ability. And therefore, if the central banks do not commit anything or give confusing communication or are very cagey in terms of their communication or slightly rude in terms of giving any kind of benign guidance, then markets will try and react adversely for positive measures also. You are looking at the measure which is past. Markets want the future. They want to predict the future because equities is a perpetuity discounting and you are not able to commit anything beyond 3 months, 6 months. So eventually they will take that these events are happening positive, but will unwind in 6 months or so, or maybe a year. Therefore, it is a non-event for us and effectively it is going to react negatively.
Abhishek, thank you so much for joining me. And before we continue, join us for the third edition of our partners Algorand India Summit on December 6th and 7th, 2025 at ITC Gardenia Hotel, Bangalore. Registration link in the show notes, and let's get back to the show. A measured approach to digital currencies. The Reserve Bank of India will continue to take a measured approach in developing the central bank digital currency, prioritizing careful assessment over speed, even as it maintains a firm position against private cryptocurrencies, according to the Deputy Governor T. Ravi Shankar, who was speaking at the Business Standards annual BFSI summit in Mumbai on Thursday. He said that India was technologically and operationally prepared to expand its digital currency pilots, but would refrain from rushing into a full-scale launch. He said many countries were experimenting with CBDC, but we do not want to rush or launch it full scale because everyone globally is just starting off. The use cases, he said, are still very different and limited, and emphasized that central banks worldwide were still analyzing the broader macroeconomic and policy implications of CBDCs, and reiterated that tech-wise use case programmability, India is by and large ready, and also highlighted cross-border payments as a key area where CBDCs could have transformative effect. He says that in the cross-border space, there is absolutely no improvement. It still takes 4 to 5 days for settlement and 5 to 6% cost of transaction. And to solve this problem, he said, he believes CBDC is the answer. Investments in ports. Danish shipping company Maersk said on Thursday its APM terminals arm may invest about $2 billion in the Pipavav port in western India. It said in a statement reported by Reuters, it signed a memorandum of understanding with the Gujarat Maritime Board on increasing capacity at the port. It also said that subject to a long-term concession agreement with Indian authorities, the expansion will significantly enhance the port's capacity and capabilities. India on a borrowing spree. Indian households have long been regarded as cautious savers but are quietly taking on record levels of debt. According to the Reserve Bank of India's Financial Stability Report, household debt in India is now 42% of GDP at the end of 2024, up from 26% in 2015. According to a new column by Dr. Ajit Ranade, economist and former vice chancellor of the Gokhale Institute of Politics and Economics in Pune and also chief economist with the Aditya Birla Group. In this column, he says that in absolute terms, the total debt is nearly 3 times bigger. The average debt per individual has jumped 23% in just 2 years, which means average debt per person is rising at twice the speed of national income. And that is an important point that we will come back to. He says that it's risen from 3.9 lakh rupees in 2023 to 4.8 lakh rupees in March 2025. Now, about 55% of this borrowing comes from non-housing retail loans such as credit card dues, personal loans, auto loans, and gold loans, while traditional home loans make up only about 29% of total household debt. He also says that an increasing share of household borrowing is being used not to build assets, but to make ends meet. A study by the Bank for International Settlements spanning 54 countries found that while higher household debt initially boosts consumption and GDP, beyond a threshold of 60% of GDP, it begins to drag growth down, reducing long-term GDP by 0.1 percentage point for every additional point of debt. India's ratio, though currently lower, Dr. Ranade says, is moving in that direction. I reached out to Ajit Ranade and I began by asking him why he felt that this was a matter of concern at this point.
Consumer debt, that is debt taken on by Indian households, is currently 43% of GDP as per the RBI's financial stability report. And about a decade ago, it was 26%. So in 10 years, as you know, GDP itself has increased possibly twice as big. So in fact, in absolute rupee terms, the household debt actually has almost tripled. So that is one thing. And as it gets closer to 60%, that's kind of considered to be a danger mark. So compared to other peer countries, 42% can be considered to be manageable. But what is of bigger concern? Two things. One is that the pace at which it is rising is almost much faster than the growth of national income or household income. And secondly, the composition of this debt, it is not debt which is taken on to create future assets, productive income generating assets. That is, if you take loans for your business or you'll take education loan for your children, or perhaps even building a house, the component that's rising faster are what are called consumption items. So either you're paying for your credit cards or you're paying for groceries. Some of it is for consumer durables, or even to pay EMIs, the EMI burden. So now 55% of all consumer loans constitute non-housing. That is, housing is about 29%. This consumption, what I call consumption-related loans for consumption items are 55%. And the remaining about 15-16% is for agriculture and business. So that's the concern. One is the pace at which it is rising. And the second is the composition is going more towards paying for consumption, current consumption items, and not creating future productive capacity.
Right. So let me look at both angles. So one is you're saying that the pace is rising. So what is it about the pace that could be of concern? Two things. I mean, one is there is a behavioral change. People are spending more. The propensity to spend is perhaps increasing. And obviously, may not be a historical benchmark. The second is what could be wrong or what is the danger here, given that the expenditure on consumption is in a way going back into the economy?
As I said, if it's not creating future productive capacity, you're simply borrowing to pay for current consumption. So there are both supply and demand factors. As you said, there's a cultural shift in the credit culture. So buy now, pay later kind of culture, or buying on credit cards. In fact, consumer durables, that is, washing machines, ACs, they are being bought with EMIs. So in a way, that is a good sign that people now have access to credit, and credit is nothing but borrowing from your own future income. So those can be considered to be positives. The desire for instant gratification and the enabling by these digital aggressive marketing channels. You must have heard many of us have got phone calls saying, I'm calling from XYZ bank and would you like a personal loan? There are these supply factors which are almost on the, you can call it loan pushing. There are demand factors which is change in credit culture. But more importantly, let's not forget factors like stagnant rural wages. People's incomes are not rising fast enough to make ends meet. So that's why they have to resort to consumer loans. The huge increase in gold loans. In the month of July, the RBI reported its 122% growth, monthly growth rate. But overall also from year to year, it's risen by 70%. Gold loan is not only a sign of some productive investment, it's also sometimes is a sign of distress. So you have to be careful. While it's good, more and more credit is available. And to the extent that it is giving a boost to consumer items and therefore industrial expansion, but you have to look at deeper into what purpose is it going, what is the credit culture, how much is the EMI stress. Even, for example, taxi aggregators, the Ola, Uber type of taxi drivers, they take loans to take a vehicle, but then they get crushed by the EMI burden. And by the way, interest rates are not coming down. So it's a bit complicated, but I think even the RBI report is putting some caution on this fast growth in consumer loans.
But in some ways, from what I can sense, your concern is predicated on not so much on the rise in the credit culture, but on the fact that incomes are not keeping pace.
That's right. If household debt was increasing and household incomes were also keeping pace, perhaps we would not have been as worried. And the fact is that the net financial assets of the households actually, by the way, are at the 47-year low. They went down from something like 11% of GDP to 5% net financial assets. So on one hand, the household balance sheet is becoming more precarious. On the other hand, household indebtedness is rising. That just says that employment opportunities, the pace of growth of household incomes is not as fast and robust to be able to bear a burden of higher loans, especially when loans are going to service current needs and not building future assets.
So if we were to look at how this has shaped up in other countries, we've talked about 43% in India. In other countries, it could go to 90%, I mean, in terms of debt to GDP or even more. But it's not a concern there. And we're obviously talking mostly about developed economies. So why is it a concern in India?
Well, for in Australia and Canada, the household debt to GDP ratio is above 100%. I think in Canada, it's even higher. And in many other countries, in the USA, it's about 70%. In China, also, it's 63%. Now, the thing is, these developed countries, by the way, have a very strong, comprehensive social security system which covers everybody. Secondly, they have deeper and much more liquid mortgage markets. They also have overall stability in household incomes. Even if the growth rate is not high, there is per capita incomes are higher. There is good unemployment insurance mechanism, which is, as I said, part of social security. India does not have these institutional buffers. In fact, households in India had something to fall back on in terms of social security that would be kind of offsetting this indebtedness. But we don't have that. So one illness in the family, some kind of shock, some kind of, a crop failure, if you're already indebted, that can really cause huge distress. And not to forget, by the way, that the phenomenon of farmer suicides in some states of India continues to be a very serious problem. And many of the suicides are related to debt problems.
Right. If we were to pose the question on demographics, now a lot of the consumption or the propensity to buy now and pay later may be younger demographics, whereas let's say the challenges of social security or grappling with issues to do with household indebtedness may only be manifest later, and therefore maybe young people are spending more clearly and doing so on credit, but it's possible that over the years things will even out. Is that something that could change or address this issue?
Well, I remember when the finance ministry folks were posed this question, the net financial assets of households is dramatically down to 5%. They kind of responded by saying that no, households are just buying more mortgages, more housing loans, and more consumer durables and so on. So they kind of almost dismissed that is not something to worry about. So in a way, when young people take on loans to buy, way beyond their monthly incomes, you can say it's a vote of confidence in their own future. That they're confident that their future is going to be brighter and they're going to get better jobs, or better incomes. So to that extent, I guess we should be encouraged. We need to look at the macro data also. Look at the youth unemployment rate. Among college graduates, the unemployment rate is almost 30%. We are hearing about job losses. We are hearing about impact of AI, automation, and all that. This is not something to be greatly alarmed about at this stage, but we have to pay attention to this phenomenon. I mean, the public policy response has to address, for example, we can have a much more broader, comprehensive, public supported social security in terms of public insurance. We do have the Arogya Yojana, the health insurance, universal health insurance. We do have the employment guarantee scheme for the rural areas and so on. Then we have the NPS and EPFO, the Provident Fund, which is for retirement, of course. So we need to see if there are enough buffers and safety nets. Credit does contribute to growth. There's no doubt about it. But we need to kind of calibrate it what is beyond, what becomes a little bit reckless. And that's the caution.
Right. And in terms of public policy responses, so for example, let's say the Reserve Bank raised risk weightages last year and now has reduced them again because it raised them precisely because of this, because there was a lot of unsecured retail lending or borrowing. Clearly, the system seems to be aware and is maybe responding appropriately. But what else could be the policy response if this is an issue that needs to be addressed, let's say, more proactively?
So the Reserve Bank will, of course, be concerned about systemic issues, about financial stability of the financial sector, banking sector, and non-banking sector also. So this policy response has to be a combination of things to be done from the monetary authorities, but also the government. Because, the Reserve Bank wants to prevent bank failures. So they increase the risk weights on these unsecured loans to 125% of the loan. And that's why microfinance loans, by the way, microfinance is also access to credit for low-income families. That actually has gone down by 16.5% in the last 1 year. But the other side is that the gold loans have gone up hugely. Now, some of it is as a substitution effect. And it's also at the same time, while RBI has been tightening the norms for NBFCs and banks as well, but they have relaxed the regulation regarding gold loans. For example, the loan to value now is allowed to go up to 85% of the gold. And now that the gold prices have gone up. So it's kind of calibrating. But beyond the monetary authorities' responses, I think we also need, as I said, to examine how can we give a comprehensive set of insurance, such as unemployment insurance, such as health insurance. So if there is widening net of comprehensive publicly provided safety nets, that then can coexist with an aggressive credit culture. So it's true that the young people, when they go for credit, When an Ola cab driver goes and buys a new Maruti car and becomes an entrepreneur in a manner of speaking, he or she is expressing confidence about their own future. But we don't want them to run into suddenly, that it's much bleaker. 1 or 2 years later, they're just trapped in working 17 hours a day and barely making enough to pay the EMI. By the way, the related phenomenon of what happened in the instant payment system is also enabling those game-related stuff. So, there are also people who are taking loans. Remember, short-term unsecured loans. So there is a lot of granularity when we look at this phenomenon. There are aspects that we need to worry about. But overall, certainly consumption spending is a driver of economic growth, and consumption spending is driven by availability of credit. Company like Bajaj, for example, has issued something like, 50 million cards. These are not credit cards, but these allow you to buy consumer durables. So you get instant loans. So those are all basically expressions of confidence, no doubt. But I'm just saying we need to calibrate. And when we get closer to 60% of GDP, we are at 43, there is research which shows that actually the growth rate starts reducing. So there is an optimality there. We can't keep on increasing consumer loans infinitely. We need to find out what the right level for India is.
Right, Ajit, that's a good note to end on. Thank you so much for joining me.
Thank you, Govind.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.